Silver's falling wedge just broke out. Right now, as you watch this. The chart every serious trader has been glued to for months has finally resolved higher, and the target that matters most is $100 silver in the next 30 days. COMEX inventory crisis is no longer a theory. It is the reality sitting underneath every futures contract on your screen, 76.9 million ounces. That is the registered silver sitting in COMEX vaults as of the latest update, available for immediate delivery against open interest of 576 million ounces, a coverage ratio of just 13.4%. Analysts have warned for years. When that ratio drops below 15%, the system starts to crack. We are below it, and the crack is widening by the day. Silver closed today around $78.38, after touching $79.80 earlier in the session. We are still 35% below the January 2026 high of $121.64, but the structure has changed. The falling wedge is gone, and in its place is the most explosive setup silver has seen since 2011. If you are new here, welcome to Unseen Economy. This is the channel that tells you what the paper price is hiding and what the physical vaults are screaming. Hit subscribe right now and turn on notifications, because the next 30 days could deliver the move that separates stackers from spectators. And while you are at it, drop your city and country in the comments. I read every single one. London, Mumbai, Dubai, New York, Toronto, Sydney, Singapore. Wherever you're watching from, this story is yours too. Let me paint the picture with numbers so there is zero confusion. January 29th, 2026, silver hit $121.64, the highest level in this cycle. Then the engineered correction began. 44% drop into the 67.85 low in mid-March. Most investors panicked. Most analysts called for lower lows. But the physical market never panicked. While the paper price was getting smashed, registered inventories kept draining, week after week, month after month. And now the technicals have aligned with the physical reality. The falling wedge on the daily chart was textbook. Lower highs, lower lows. Volume contracting on every decline. Exactly what professionals look for when they want to catch the violent reversal. The breakout candle we just witnessed closed above the upper trend line with conviction and expanding volume. That is not noise, that is confirmation. The measured move from this wedge is simple math. Take the height of the wedge at its widest point, project it upward from the breakout level. You land between $98 and $105 as the minimum technical target. But that is just the chart talking. Overlay the COMEX data and the math becomes far more aggressive. 76.9 million ounces registered. That number has been falling at an average of 1.3 million ounces per week during stress periods. At current pace, we are looking at single-digit millions within 60 days if withdrawals continue. And withdrawals are continuing because someone out there needs the metal, not the promise of metal, the actual bars. This is the part most YouTube channels gloss over. They show you the pretty chart and say, to the moon. I'm going to show you why the moon is the conservative target. Open interest sits at 576 million ounces. That means for every ounce of registered silver, there are roughly 7.5 paper claims, 7.5 to 1. In a normal market, that ratio stays manageable because most contracts roll. But when physical tightness hits, the roll stops working. Traders who need metal start standing for delivery instead of rolling. And that is when the fun begins. We are already seeing the early tremors. Lease rates in London have started to firm. GOFO rates for silver are no longer negative in the front months. Physical premiums in Dubai and Shanghai are holding firm, even as the COMEX spot price wiggles. These are not random. These are the market's way of telling you the paper price is lying. The April delivery cycle is live. Standing delivery demand is building faster than most models expected. If even 8 to 10% of open interest decides to take delivery instead of rolling, the registered pool cannot absorb it without going to zero. And going to zero is not theoretical anymore. It is the logical endpoint if the current depletion rate holds. Now let me give you the historical context that makes this moment different. In 1980, I will show some data. Silver from $6 to $50 in months. The trigger was the same. Too much paper, not enough metal. The exchange changed rules mid-squeeze, but the price still exploded before the rules could contain it. And then in 2011, some figures turned in markets. Silver from $28 to $49 in weeks. Same story. Physical tightness met leveraged paper shorts. The result was a vertical move that most retail traders missed because they were waiting for more confirmation. Confirmation is what happens after the move is half over. We are at the confirmation point right now. The wedge has broken. The inventory ratio is at crisis levels. The delivery calendar is tightening. But here is the part that separates this setup from every previous one. The industrial demand floor has never been higher. Solar alone is projected to consume more silver in 2026 than the entire mine supply of some smaller producing countries. Electric vehicles are doubling their silver content per unit compared to internal combustion engines. 5G rollout, AI server farms, advanced medical devices. All of it pulls from the same shrinking pool of above-ground silver. Mine production has been flat to down for 5 straight years. Recycling rates cannot fill the gap. The structural deficit is not coming. It is here. While the paper market was busy painting lower prices in March, the physical buyers never stopped. China imported record volumes through the Shanghai Gold Exchange. Indian jewelry and industrial demand remained robust despite the price correction. Strategic stockpiling by sovereign entities continued quietly. The COMEX is the only place left where the price still pretends everything is normal, and that pretense is about to end. The falling wedge breakout is the signal that the smart money has been waiting for. Not the retail crowd chasing the pop, the institutions that move size. They have been accumulating the physical while the chart looked ugly. Now the chart looks beautiful, and they are already positioned. So when I say $100 in 30 days, I am not pulling a number out of thin air. I'm connecting 3 dots that have never aligned this perfectly before. Dot 1, technical measured move from the wedge gives us $98, $105. Dot 2, COMEX coverage at 13.4%, plus accelerating delivery demand creates the squeeze mechanics that historically add 30 to 50% on top of technical targets. Dot 3, the structural, industrial, and monetary demand that was absent in previous cycles is now the dominant force. Add those 3 together, and $100 becomes the floor, not the ceiling, if the squeeze ignites. And the 30-day timeline? That comes from the delivery calendar staring us in the face. April notices are already elevated. May and June are historically the heaviest months for industrial offtake. If the registered pool drops another 8 to 10 million ounces in the next 30 days, and the current trend says it will, the mathematics become brutal. Shorts will have no choice. They either cover or face delivery they cannot fulfill. Either path sends price higher in a straight line. This is not hopium. This is what the data has been building toward since the January peak. The correction was never about fundamentals. It was about flushing out weak hands and resetting the paper leverage. The physical market absorbed every ounce thrown at it. And now the technicals have caught up. The wedge is broken. The inventory is bleeding. The countdown has started. In part 2, I'm going to show you the exact catalysts that can ignite this move in the next 30 days. The specific delivery numbers, the lease rate spikes we are already seeing, the industrial contracts that are quietly being signed at premiums the spot price does not reflect, and the one geopolitical wildcard that could turn a 30-day move into a 10-day explosion. But before we go there, I want you to do one thing. Look at your own position. If you are holding physical silver, you are already ahead of 99% of the market. If you are looking to add, the breakout retest is the highest probability entry we have seen in this cycle. If you are in miners or leveraged products, understand that the asymmetry has never been greater. This is the moment the market shifts from maybe to happening. Drop your thoughts in the comments right now. Are you already stacked? Are you adding on this breakout? What is your personal target for silver by the end of May? I read every comment, and I will see you in part 2 where we go deeper into the numbers that will decide whether $100 happens in 30 days or 30 hours. The wedge is gone. The crisis is real. The clock is ticking. The wedge is broken. The inventory is bleeding. Now let us talk about what actually ignites the move to $100 in the next 30 days. Because the technical breakout is only the spark. The real fuel is sitting in the delivery calendar, the lease rates, and the industrial contracts that the spot price still pretends do not exist. Let me give you the numbers that matter most right now. As of the latest CME data, the April delivery cycle has already seen standing demand build to levels that represent 12.6% of the entire registered pool. 12.6%, before first notice day even hits. In March, the ratio was 59% of registered inventory standing for delivery at one point. That is not normal market behavior. That is stress, and the withdrawals keep coming. 1.3 million ounces left the registered category in a single recent update. Another 1.5 million ounces moved out of eligible in the last 30 days. These are not small numbers. These are the ounces that will never return to the COMEX system once they are delivered into strong hands. The physical market is voting with its feet, while the paper price is still trying to act like nothing is wrong. Now let us talk about lease rates, because this is where the stress shows up before the price does. London lease rates for silver have started to firm in the front months, not dramatically yet, but the direction is clear. When registered inventories drop below 80 million ounces, lease rates historically begin their vertical climb. We are at 76.9 million. The next 5 million ounces lower is where the exponential move usually begins. GOFO rates for silver are no longer deeply negative in the near term. That tells you the market is starting to price in the possibility that physical metal might actually be scarce when delivery time comes. This is the canary in the coal mine. Lease rates do not lie. They are the market's real-time stress test, and the premiums tell the same story. Physical silver in Dubai and on the Shanghai Gold Exchange is trading at premiums the COMEX spot price does not reflect. Industrial buyers are paying up for guaranteed metal, while the paper traders on COMEX are still fighting over who gets to be short at $78. This divergence cannot last. Eventually, the paper price has to catch up to the physical reality. And when it does not catch up slowly. Now, let me show you the industrial demand that is quietly swallowing silver at a rate the mine supply cannot replace. Solar photovoltaic demand alone is projected to consume more than 180 million ounces of silver in 2026. That is more than the entire annual mine production of the top 3 producing countries combined, and there is still no commercially viable substitute at scale. Every solar panel that rolls off the line pulls silver paste that cannot be recycled back into the system fast enough. Electric vehicles are the second hammer. A typical EV uses between 25 and 50 grams of silver per vehicle. That is 2 to 3 times more than a traditional internal combustion engine car. Global EV production is on track to exceed 18 million units in 2026. Do the math. That is another 450 to 900 million grams. 450 to 900,000 kilograms. All of it coming from the same shrinking above-ground pool. 5G infrastructure, AI data centers, advanced semiconductors, medical devices. None of these are optional. None of these are cyclical. They are structural demand that grows every single quarter regardless of what the paper price is doing. While the speculators were busy shorting the March correction, while the industrial buyers were signing long-term offtake agreements at premiums the spot price has not yet acknowledged. Those contracts are already priced in the $85 to $95 range for 2026 delivery. The paper market is still trading at $78. That gap is not going to close gently. Now let us talk about the monetary side that most analysts still ignore. De-dollarization is not a theory anymore. It is happening in real time. BRICS nations are expanding currency swap lines and exploring commodity-backed settlement mechanisms. Silver, with its dual role as monetary metal and industrial necessity, sits at the exact intersection of both trends. Central banks and sovereign wealth funds have been net buyers of precious metals for 3 straight years. While most of the attention goes to gold, silver is quietly being accumulated by the same players who understand that the paper system is running out of road. China's strategic imports through the Shanghai Gold Exchange have remained robust, even during the price correction. India's physical demand from jewelry and industry never missed a beat. This is not retail FOMO. This is sovereign and industrial accumulation at the highest levels. And that brings us to the geopolitical wildcard that could compress the 30-day timeline into something much faster. The current U.S.-Iran diplomatic talks are creating short-term relief in risk assets. The dollar has firmed. Gold and silver both pulled back on the news. But here is what the market is missing. Any deal that reduces immediate geopolitical risk also reduces the urgency for some paper shorts to cover. That is the trap. Because the physical tightness does not care about diplomatic headlines, the inventories are still draining, the industrial contracts are still being signed, the delivery calendar is still tightening. When the diplomatic relief fades, and it always does, the market will remember that the structural problems never went away. And the short covering that was delayed will come back with even more force. That is the wild card. A sudden shift in headlines could turn a 30-day grind into a 10-day vertical explosion. But even without the geopolitical spark, the mathematics are already brutal. Let me walk you through the scenario that gets us to $100 in 30 days without any external catalyst. Assume the registered pool drops another 8 million ounces over the next 30 days. That is conservative based on the current trend. We are now at 68.9 million ounces registered. Coverage ratio falls to 12%. At that point, the April and May delivery cycles together represent more than 25% of the remaining registered pool. If even 15% of open interest stands for delivery instead of rolling, the COMEX has a problem it cannot solve with accounting tricks. The exchange has 2 choices: declare force majeure and delay deliveries, or force shorts to cover at whatever price clears the market. Either path sends silver higher in a straight line, and the measured move from the falling wedge plus the historical overshoot from previous squeezes lands us at $100 to $105 as the first stop. This is not guesswork. This is what happened in 1980. This is what happened in 2011. The only difference this time is the industrial demand floor is 40% higher than it was in either of those cycles. So when I say $100 in 30 days, I'm not being dramatic, I am being conservative. The real question is not whether it happens. The real question is whether you are positioned when it does. In part 3, I'm going to show you the exact risks that could delay or derail this move, the manipulation attempts we should expect, the one data point that would invalidate the entire thesis, and the precise action steps for physical stackers, miners, and leverage traders. But before we go there, I want you to internalize one truth. The falling wedge breakout was the signal. The COMEX inventory crisis is the fuel. The industrial and monetary demand is the accelerant. The only thing left is the spark. And that spark can come from anywhere in the next 30 days. Drop your thoughts in the comments right now. Are you watching the lease rates? Are you tracking the delivery notices? What is the one number you're watching most closely over the next month? I read every single one. The wedge is gone. The crisis is real. The countdown is live. The setup is complete. The wedge has broken. The inventory crisis is real. The catalysts are aligned. Now let us talk about the risks, because only amateurs ignore them. And I'm not here to sell you a fantasy. The biggest risk is not that silver goes lower. The biggest risk is that the move takes longer than 30 days because the shorts still have one last card to play. They will try to smash the price again. They always do. On any geopolitical headline, on any strong dollar day, on any random options expiration. Expect it. The paper market still has leverage. They can push silver back towards $74 or even $72 in a single session if they coordinate the attack. But here is what they cannot do anymore. They cannot refill the registered pool fast enough. Every ounce they smash lower gets bought by someone who actually wants the metal. China, India, industrial consumers, sovereign buyers. The same players who absorbed the March correction are still absorbing, and they are not selling back into the COMEX at these levels, so the smash attempts will happen, but they will fail faster and harder than in previous cycles, because the physical floor is higher, and the registered inventory is lower. That combination has never existed at this scale before. The second risk is time. 30 days is an aggressive timeline. If the diplomatic talks between the US and Iran produce a lasting de-escalation, some of the urgency could fade for a few weeks. Lease rates might stabilize. The squeeze could stretch into 45 or 60 days instead of 30. That is the realistic bear case. Not lower prices, just slower timing. But even in that scenario, the technical target from the falling wedge still sits at $98 to $105, and the structural deficit does not disappear just because headlines improve. It only gets worse the longer the paper price stays suppressed. Now let me give you the one data point that would actually invalidate this entire thesis. If COMEX registered inventory suddenly starts rising by more than 5 million ounces in a single month without a corresponding collapse in open interest, the squeeze thesis is delayed. That would mean new supply is entering the system faster than deliveries are removing it. It has not happened in 18 months. And given the structural deficit, it is unlikely to happen now. But if it does, we wait. The technicals are still bullish. The industrial demand is still growing. We simply recalibrate the timeline. That is the only data point that changes the story. Everything else is noise. Now, let us talk about what you should actually do. If you are a physical stacker, your job is simple. Keep stacking on any dip below $76. Focus on allocated and segregated storage. Avoid unallocated paper promises. The goal is not to time the exact bottom. The goal is to own real metal before the paper market loses control. You're already ahead of 99% of the world. Do not let short-term volatility shake you out. If you are looking at miners, the asymmetry is extreme. Primary silver miners with low all-in sustaining costs will see 5x to 8x leverage on a move from $78 to $100. Byproduct producers will see 3x to 4x. The ones with clean balance sheets and proven management will be the biggest winners. This is not the time to chase the highest beta names blindly. This is the time to own the companies that can actually survive and thrive when silver is at $60 or $120. If you're a paper trader or options player, the game has changed. The falling wedge breakout gives you a clear invalidation level. Below the recent swing low and the setup is broken, above the breakout high and the measured move is in play. But understand the gap risk. When these squeezes ignite, they do not give you 5 days to adjust. They gap. Position size accordingly. And never risk more than you can afford to lose in a single session. The most important thing is not which vehicle you choose. It is that you choose something. Because sitting in cash while this setup resolves is the highest risk move of all. Let me bring this full circle. In January 2026, silver hit 120 panos and 64. Most people thought the bull market was over when it corrected 44%. They were wrong. The correction was the setup, the falling wedge was the trap. And the COMEX inventory crisis is the trigger that was always coming. We are now at the moment where the narrative shifts. From silver might go higher to silver is going higher, and the only question is how fast. The 30-day timeline to $100 is not a guarantee. It is the base case if the current trajectory continues. And the current trajectory is the most bullish setup silver has seen in 15 years. The wedge is broken. The inventory is at crisis levels. The industrial demand is structural. The monetary demand is accelerating. The shorts are running out of metal to deliver. Everything that needs to align has aligned. The only thing left is you. Are you positioned? Are you watching the right numbers? Are you ready for the volatility that comes with a real squeeze? Drop your answers in the comments right now. I read every single one. Tell me your stack size. Tell me your target. Tell me what you're watching most closely over the next 30 days. If this series gave you clarity, hit like. If you want the follow-up when we hit the first major target, subscribe and turn on notifications. Because this story is not ending at $100. It is just beginning. The paper game is cracking. The physical reality is winning. And the countdown to the biggest silver move of this decade is live. I will see you in the next one. Stay sharp, stay stacked. And never forget, in this market, the metal always has the final word.